There are many people who worry about safety, who worry about the state of their money, and also who are just not risk averse, who end up sitting with a lot of money in their bank accounts. You'll find a person sitting with over 100,000 in their bank account. Now, there's a certain amount of money that you can sit with in a bank account, which is acceptable. But then there comes a time whereby a certain amount of money is just not wise to keep in a bank account. And that is because of many reasons. On today's video, I'm just going to be sharing with you why you should not be keeping lots of money in a bank account and how it disadvantages you. And then lastly, what you can do instead. So let us get into it. But firstly, before we do that, let me first introduce myself. My name is Jennifer Nxumalo. I'm a content creator as well as a businesswoman, currently self-employed. And in this channel, I create personal finances, career, as well as lifestyle content. So if any of those are things that interest you, do make sure that you join us by clicking that red subscribe button on the bottom. Now let us get into it. There's a reason why bank accounts were created, how to best use them. Bank account was created for you to be able to transact. So that would be for you to be able to receive your income, because in this country, we no longer use things such as checks and so forth. So you don't get paid with the check, but rather supposed to go into your bank account. This also allows for SARS to be able to track how much money you have made or you have earned in that year. So a bank account is created for that, for you to be able to receive as well as send money. So you can either be sending money to a friend, or you can be putting money, you can be transacting or basically sending money into your investment portfolios. But the whole point here is to have one place where, even multiple places, but you have this one designated place where you are receiving your income, you are receiving money, and you are able to send money from this. So that is the first and the main point of banks. And that is actually what they strive at and basically focus on when it comes to providing a service to you and me. And the second thing that you can do with a bank account is to be able to save. Things such as your short-term savings, not your long-term savings and your long-term investments. You can't do that with a bank, but you can have your short-term savings. Short-term savings such as the stock files, such as your emergency fund, also such as your sinking fund. A bank is perfect for that. Why? Because in your bank account, you can then open savings account where you can put in this money, but then you know that you want to be able to access this money whenever you need it, when the time arises. You can fix it for a set period, or you can also put it under a notice. That is up to you, or you can just leave it easily accessible. But a bank account is perfect for saving for short term. Now let's talk about the amount. In your bank account, it is advisable that you can keep up to 100,000. That is assuming that it is saved and it is fixed, because up to 100,000 in this country is insured with banks per person. So if you have about 100,000 saved in a bank, it is insured. Anything above that, it is not insured. So you want to keep up to 100,000 in your bank account, and that is assuming that you are saving this for a purpose and it is fixed. It is fixed, not easily accessible, and it also has a notice period. You cannot be sitting with 50,000 in a bank account, 60,000, 70, 80,000 in a bank account, and it is not fixed. It also has no notice, because you are just putting yourself at more and more risk. We'll talk about that later on. Now, I want us to talk about what does a bank do with your money. Now, this is not to say don't utilize the bank. As you have seen, I'm not bashing banks here, and I'm also not saying don't utilize bank account, because we all need them. But I just want you to use them wisely, because there are people who are so scared to invest, who are so scared to find other ways to grow their money, and they would rather just be sitting with hundreds and hundreds of thousands in their bank accounts and thinking that they are safe. You're not. You're actually putting yourself at far greater risk than anyone who's actually investing their money in any form of an investment. That could be in property, in shares, or in bonds. But those people are far safer than you if you are sitting with hundreds and hundreds of thousands in your bank accounts. Let's talk about what do the bank do with your money, right? You deposit money into the bank. Then you say, okay, I want a savings account, and then they give you about 7.5 or maybe 7%, likely you get about 8% depending on the type of savings. But let's say they give you 7% interest, right? What the bank does is that they don't keep your money. Like, don't think that just because you sit on an account, then it's like they don't keep your money. Yes, technically, when you look at it, you'll see the digits there. It will show the interest and so forth. But that money is not sitting at the bank. Your money is then invested. So it can be invested in terms of lending out to people. So it can be borrowed to people with an agreement that they will pay back the money with the interest charged on it. They can do that, or they can invest it in the JSE market, buy stocks with it, or they can also trade it. That's what banks do. They can trade that money with an assumption that if they trade it in the market, they will make a certain amount which will come back. Now, what they will then do is that whatever money that they make through either lending, trading, or investing your money, their interest that they make, they give you the one that you agreed upon. You agreed on 7%, right? When you took out their savings account, they'll give you 7% of your money, not of how much they earned. They'll give you 7% of how much your money is worth. So if you had 100,000 there, they'll give you 7% of 100,000, not of how much they made. Right? So you find that banks end up making a lot of money out of people's money, because that's just how they are. That's how they are also structured and also financed. They make money through that. They will make a lot of money. They'll go out and make a lot of money, but then they'll come back and give you a small portion of that. So that is what a bank does. And that is also not to discourage you to say then don't use a bank. No, you can still use a bank account, still have your money saved, but you need to be wise in terms of how much money you are keeping in there. You don't want to be having all of your money sitting in a bank and just allowing a bank to just be using your money to do whatever that they want to do with it and keeping the majority of those earnings and then giving you a small portion of that. Another thing that I want us to look at is the issue of inflation, because that also does eat away on your money. So you took your money, you put it in the bank, they gave you a percentage of 7%. The inflation right now is over 3%, right? Now, if it's over 3%, then you would say 7 minus 3%, let's just say minus 3%, but it's over 3% currently, the inflation. But minus 3%, just for sakes, let's round it up. You'll be left with 4% of interest in terms of value now, because you did save money there, right? And they gave you 7%. But because of inflation that chows away on your money, then you have to be cognizant of that. So now the value of your money, or the value of how much your money has grown, it will not be 7%, but it will rather be 4% because of what you have to account for the inflation. Now imagine sitting with hundreds and hundreds of thousands in savings account, be a savings account, and just thinking, but I'm earning interest. By the time you want to use that money, it won't be valued that much. And then another thing is that you will end up going on a spending spree. If you've got money that you have just left in your bank account, you are just able to see and access anytime, it registers in your mind that you've got money. And what you then do is that you end up going on a spending spree. And when you go up on the spending spree, you keep telling yourself that I've got money. Like, I'll give you an example with me. Like, I've got my emergency fund, right? So what I do is every month when I need money from my emergency fund, I will go and I will withdraw that sum of money that I need based on my budget. Instead of withdrawing all of the money that I have saved for my emergency fund, I don't do that. And that is because I know that if I withdraw all of that money and I have it sitting in my transactional account, there's a 99% chance that I'm going to end up overspending and going on a spending spree, because in my mind, it will feel like I've got money and I'll just keep using that money recklessly. So what I do is that I only withdraw what I will need for that month. And then I'll wait for the following month, I will withdraw what I need for that following month. But if I sit with money in my transactional account, for me, it registers as I've got money. And so I keep going on a spending spree. So if you've got money just sitting in your bank accounts and you're able to see it and access it, you end up spending that money and without you having planned it, because why? For you, it feels like you've got a lot of money. Another thing that I want us to look at is just how this poses a risk on you. I spoke about this briefly before when it comes to the risk that it poses on you when you sit with a lot of money in your bank account. You are posing yourself in the risk of fraud and as well as crime. We know of so many stories whereby a person gets hijacked and then they're asked, transfer all of your money out. They're asked, go and withdraw all of that money. But if your money is invested either on assets like shares, it's also invested in terms of property, you have it, you bought some assets with it. Liquidation is not as easy and it's not as immediate. Also with fraud as well, we know of so many stories whereby people have went into people's account. I've also had issues with fraud where some people went into my bank account and took the money that was in there. Now, if they were able to only take the money that was sitting in my transactional account, now imagine if I was having money in my savings. There are scammers and fraudulers that are able to literally transfer money from your savings account. So let's say, for instance, you've got Capitec and you had it fixed and so forth. They're able to move money from your fixed to your transactional and then be able to take your money. So imagine sitting with hundreds and hundreds of thousands that is just sitting in your bank account, and these people can literally be able to have access to that money, have access to go into your bank account and see how much money you have, and then tell you that this is what I want, take this out. Or they do it themselves. So you pose yourself in far greater risk when you are actually doing that, when you are actually putting your money in that way where you're just leaving it lingering in a bank account. If you find yourself, let's say for instance you've been saving and you realize that your savings are really accumulating and it's getting to a point whereby it's getting out of hand, because as I said, there's a certain amount that is acceptable to keep in the bank, but now you can see that this is getting out of hand. This is what you should do. Let's say for instance now you got into 100,000 and now you start saying 120, 130, and this thing keeps going. This is what you should do. And this is not coming from me as a financial advisor. It's just coming from me as Jen from the blog. But do check with a financial advisor, not a banker. Not with a bank. Go to a financial advisor and actually get advice in terms of, okay, I'm finding myself sitting with a lot of cash. And I want a way that I can actually preserve this cash, allow this cash to work for me, but also still keeping this cash safe. That will be the best thing you can do for yourself. But now I'm just going to give you something that you can nibble on, think about. This is not to say take it as financial advice, right? As I said, I'm not a financial advisor. I'm just sharing you on the blog. First thing, if you've got your emergency fund that you've building up and then you see that you're getting over 100,000, keep up to 3 months worth of emergency fund in your savings account, easily accessible. The rest, put it somewhere else. Invest it in a low risk asset. There are so many low risk assets that you can invest on, that you know that they are not highly subject to the economic crisis and the fluctuations in the market. You can go that route. That way you know that you have that. An example of that is a money market, you guys. Money market is very similar as saving, but at least you are not doing it with the bank. You're not giving the bank your money and say, sit with it. Rather, it's going to be invested into the money market. It's going to be sitting there and earning interest and working for you. And that is a very, very safe way of investing. So you would rather take a portion of your emergency fund. If you feel that your emergency fund is that big, rather take a portion of that, put it in the money market. Alan Gray offers this. Frank Group offers this. So you can go that route and just put your funds in the money market. Leave those funds there while you still have a portion of your emergency fund saved with the bank. So that's the first thing that you can look into. I must not say should or must. You can look into. I don't want anyone to come for me. The second thing that you can do, consider buying government assets, government bonds. So you have this money have been sitting in your bank account. Now we're no longer talking about your emergency fund, but you're talking about the fact that you've just been accumulating savings in your bank account. Look into government bonds, right? Government bonds have good interest rates, up to 11%. And then you can also invest. You can buy government bonds for 3 years. You can buy government bonds for 5 years. And knowing that, and the nice thing is that your money, while it is there, and by the way, when you buy government bonds, do know that it's not like you are putting your money in a savings account where it just sits. No. When you buy government bonds, you're basically saying to government, here's my money that I'm willing to invest in you to go and improve the infrastructure of this country, to go and fix things in this country, to go and do this, to go and do whatever that you want to do as the government of this country. We're speaking of treasury right now that is responsible for this. That is what you do when you take your 500,000, your 100,000, your 200,000, you buy government bonds. That's exactly what you are doing. But now you give them for a set period of time. You buy these bonds for three years, with this record that now you have with Treasury, that you have got into an agreement with them where you've lended them your money. You become the lender, but then now you are now getting the 11% interest for a set period of time. Now you are saying, in this period of time, these 3 years, you're going to be getting interest of 11%. End of these 3 years, your whole money will be coming to you. So you can decide whether you want to keep reinvesting the interest back into the government bonds, or you want the payout of the interest per month. So then they will give you a set amount based on how much you put in and the interest rates and the term. Then you get that money per month, or you can reinvest it. So you can go that route of government bonds. And then a third thing that you can do is to invest it on low risk assets such as your mutual funds, your REITs, and then also your ETFs. That it's also a safe way. The reason why these are safe, like your ETFs, is because you're just not betting on one asset. We're speaking of a lot of assets that are grouped into one. And that also provides you with diversification. So when it comes to now, you having a lot of money, get into investing. But then as you are starting out, don't go and buy individual stocks. Go and buy assets that are grouped, that are fully diversified for you. And also this also helps when it comes to minimizing the risk. So it happens, let's say for instance, it happens that the market crashes. When you have ETFs that you have bought, the nice thing with them, yes, they may go down and they may lose value maybe during that crash. But then because of how well they are managed over the years, they have bounced back. In all of the crashes that have been there, they have bounced back. That is why you want to go the route of the ETFs in terms of the stocks. The last one is buy an asset. But that is if you know that you're not going to need this money in the next 7 to 10 years. Then buy an asset, buy property, get into property investing, get into, those things. But the whole point of this video, guys, is to say, do not sit with a lot of money in your bank account. It is very reckless, very, very reckless. You're putting yourself at risk. You're putting your assets at risk as well. You're actually offering yourself no diversification. You keep telling yourself that it is safer that way, but it's actually more riskier for you than for you to invest your money. Sitting with money in a bank will cost you, not just in terms of the inflation, but will cost you in terms of the fees that are associated with this thing each and every month. It is eating away on your money. And then by the time you want to use it, it has also lost value. So you would rather think, okay, how best will I be able to put this money? If I'm going to invest it, I'm going to make sure that I do it right. I'm not going to gamble with this money. I'm not going to buy individual stocks with this money, but I want to buy an asset. And I said, okay, which assets can I buy that is best performing, that I know that even if I buy it now, yes, I'm putting my money at risk because I'm buying shares with it, but that has proven track record of growth. And also it will be away from the prying eyes of fraudulents, as well as the criminals that are always looking to steal people's money. So I really want you to challenge yourself that as much as maybe you are not comfortable with just parting away with your money, you feel better seeing your money sitting in a bank account. I really want you to be thoughtful and really think wisely about that. Is that really wise? Find ways that you can go about making sure that you are putting your money to work and protecting your hard-earned money as well. As I said, please find a financial advisor, a registered financial advisor that will take you through this. You don't have to do anything with them. Only thing you can do is ask for advice. You don't have to take any product that they offer you. You take the advice, reassess the situation, and then you go with what will work best for you. I would rather say seek financial advice and find ways that you can go about this. Come back home, come back to the drawing board and decide. So I'm going to close it off right here. I hope that this convinced you enough to say, be a wise person. Don't sit with a lot of money in your bank account. As I said, up to 100,000 is insured in this country in your bank account. So if you've got more than that, you are putting yourself under risk. And this is not to say that if you buy an asset, it's not risky. If you buy shares, it's not risky. If you buy bonds, it's not risky. Yes, it is risky. But then when you diversify your portfolio and you are very wise about the asset that you choose, you minimize the risk as much as possible. That's why in this video, I did not speak anywhere to say go buy stocks. I did not say go buy Capitec. I did not say go buy ShopRite. I did not say go buy apps. I didn't do that because I understand how volatile it is to go that route. But when you properly diversify and you choose the right assets for you, then you minimize the risk as much as possible. So with that being said, I'm going to close it off right here. I hope that you enjoyed this video. If you did, please make sure that you give it a thumbs up. And if you've got questions, leave them down below. I will see you guys on the next one. Please take care and stay safe. Bye.